So let's start with the business segments, and Berkshire Hathaway is very diversified. They operate in insurance, manufacturing, gas stations and travel centers, energy, logistics and supply chain. They own a railway and different service and retailing businesses. Beside these examples, Berkshire owns many more companies, especially in the insurance, manufacturing, energy and service and retailing segments, and it would be impossible to show them in a single slide. What I want to illustrate with these examples is that Berkshire is also diversified within these business segments. With Geico, they own a car insurer, but they also offer reinsurance or specialty insurance products. With Dairy Queen, they own a whole restaurant chain, a home builder with RC Willys, or a candy manufacturing business with See's Candies. So the most important thing to understand is that Berkshire is well positioned in various industries and owns high quality businesses in different sectors of the economy. They maintain an organizational structure which is decentralized, and each subsidiary has its own management team with great amount of autonomy. The largest sale drivers in 2023 were the insurance and manufacturing segments, each accounting for around 29% and 23% of the total revenue. This is followed by the logistics and supply chain company McLane and the gas stations and travel center operator Pilot Flying J with 16% each. Berkshire Energy and BNSF, on the other hand, each account for around 8%. Now that we know how Berkshire Hathaway is organized and where the company gets its money from, we can look at the stock chart over the last 10 years. With a performance of 196%, Berkshire has beaten the S&P 500 by about 12%. I think it is becoming increasingly difficult to beat the S&P 500 with a company like Berkshire in the coming decades. Berkshire is one of the biggest companies in the world, and they would have to acquire companies with a large market cap to make a significant difference. Finding these high-quality companies at such a market cap and a good price is quite difficult though, and takes a lot of patience. Speaking of performance, we haven't took a look into Berkshire's investment portfolio yet. With the current market capitalization of $970 billion, the investment portfolio would make up about 27% of the entire company, which is very important for the investment thesis of Berkshire. With Warren Buffett, you have probably one of the best capital allocators in the world. His investment philosophy is to invest in businesses and not stocks. He always buys shares within his circle of competence and focuses on the long-term potential of the companies. Many businesses of the concentrated investment portfolio pay a significant dividend, which contributes to Berkshire's income. His 10 largest positions, which are listed on the slide, make up around 90% of the portfolio. With Apple or Coca-Cola, Berkshire owns strong brands which have competitive advantages. He also has major positions in the financial sector with Bank of America and American Express since 2008. In the recent months, Warren Buffett also increased his stake in Occidental Petroleum, with Chevron and Oxy covering the increasing energy demand in the US. Berkshire is also well positioned with strong cash flows. Warren Buffett's investment strategy has developed over a long period of time. It is very interesting because it is influenced by two special people: his former business school professor and mentor Benjamin Graham and close business partner Charlie Munger. Early in his career, Buffett followed the investment philosophy of his mentor Benjamin Graham. This approach, often called the cigar butt strategy, focused on buying deeply undervalued companies, ones that might not be great businesses, but still had a few puffs of value left in them. When Buffett partnered with Munger in the 1960s, everything began to shift. Munger, inspired by the ideas of investor Philip Fisher, believed in a different approach, buying high-quality businesses with strong competitive advantages and holding them for the long term. Munger convinced Buffett that it was worth paying a fair price for a great business instead of focusing solely on cheap stocks. These are companies with durable competitive advantages, what Buffett later called moats, and consistent earnings over time. In addition to the people listed, Berkshire Hathaway employs many other essential individuals. From an investor's perspective, I've listed the 4 most important people besides Warren Buffett. Ajit Jain and Greg Abel both serve as the vice chairs of operations. While Greg Abel is responsible for all business segments outside of the insurance businesses, Ajit Jain focuses on Berkshire's insurance segment, which he does exceptionally well, having built Berkshire into one of the world's largest insurance groups. Since 2021, it's been confirmed that Greg Abel will be Warren Buffett's successor. It's reasonable to assume that Berkshire Hathaway is in good hands with him, as Abel rose through the ranks at Berkshire Hathaway Energy and has a deep understanding of the company and its culture. However, this passing of the torch from Warren Buffett is not without its challenges. Greg Abel will be stepping into the shoes of one of the most celebrated investors of all time. Even if Buffett were to step down, the investment portfolio would not be in danger. While it's said that Warren Buffett is still responsible for the major portfolio positions, he's not the only one managing capital at Berkshire. Todd Combs and Ted Weschler are also portfolio managers who manage relatively smaller amounts than Warren Buffett. It's likely that Todd Combs or Ted Weschler are behind these smaller positions in companies like Nubank. In the event of Buffett stepping down, Todd and Ted would likely become the future duo in charge of the portfolio. Taking a look at the ownership structure of Berkshire, the most important shareholder is still Warren Buffett himself with 37% of the outstanding shares. Other important shareholders are, of course, the well-known institutional asset managers such as Fidelity or Vanguard. The fact that Warren Buffett still holds his entire fortune in this share is a sign of conviction and passion that offers a certain security. Personally, I always look for a high level of participation in the company by the management. Berkshire has grown steadily over the last 10 years. Its revenue increased from $182 billion to $364 billion, with an average annual growth rate of 7.18%. Most of its revenue comes from the US, which aligns with what Buffett always says: never bet against America. That's why he continues to focus on US investments. Looking at earnings per share, we see a similar CAGR of 7.17% over the last decade. However, since 2018, EPS has been more volatile. This is due to a change in accounting rules, which requires companies to report unrealized gains or losses on their stock holdings as part of net income. If stock prices fall, it looks like Berkshire is losing money, even if they haven't actually sold any shares. Since Buffett is a long-term investor, these short-term swings don't really affect Berkshire's true performance. Berkshire's operating margin and net margin have also improved over time, despite the impact of its investment portfolio. This shows that the company remains strong and continues to grow steadily. Lately, there has been a lot of talk about Buffett selling stocks, which you can see in the growing total cash and short-term investments. He recently sold a large amount of Apple shares and moved billions into treasury bills to take advantage of higher interest rates. At last year's annual meeting, Buffett explained that he doesn't see many attractive investment opportunities in the stock market right now. This makes sense when you consider Berkshire's size. As I said before, the company has billions in cash and needs to invest in big businesses to make a difference. But with many large companies in the S&P 500 being overvalued, Buffett prefers to earn safe returns from T-bills instead. In my opinion, for small investors, the situation is different. Unlike Berkshire, they can invest in smaller companies that Buffett can't buy. So even though Berkshire is being cautious, individual investors can still find good opportunities in the market. Coming to the cash reserves and financial strength, Berkshire has more cash than debt, meaning its financial position is very strong. In times of market uncertainty, this gives Buffett the ability to make great investments when prices drop. Since 2019, Berkshire has been buying back its own shares to reward investors. While Buffett personally likes receiving dividends from other stocks, Berkshire doesn't pay dividends itself. Instead, It reinvests into new investments or share buybacks, which helps investors to increase their shares in the company and is more tax efficient for shareholders. To summarize everything, Berkshire's fundamentals look strong. While the company is no longer growing as fast as it once did, its high cash reserves, steady share buybacks, and low debt keep it in a solid position. But what about the valuation right now? Before diving into the discounted cash flow analysis, it's important to mention that this method has limitations for large conglomerates like Berkshire. The company earns revenue from multiple businesses, making it difficult to predict future free cash flows accurately. That's why I see DCF more as a Roth guideline, helping to determine whether Berkshire stock offers a margin of safety before investing. Now let's look at the numbers. Berkshire's free cash flow has grown at a CAGR of 7.44% from 2009 to 2023. I've calculated the weighted average cost of capital at 8.59%. For the terminal growth rate, I assume it aligns with inflation. If Berkshire continues growing free cash flow at 7.44% per year until 2032, this results in a fair value of $468 per B share. Right now, the stock trades around $468, meaning it's fairly valued with no margin of safety, which suggests it might not be the best time to buy. Even Warren Buffett himself has paused share buybacks, which could indicate that he also sees the stock as fairly valued. If he thought the stock was undervalued, he would likely continue buying back shares. So based on this, it might be better to wait for a better buying opportunity instead of jumping in right now. In conclusion, Berkshire provides you with a great management under the investment legend Warren Buffett and a diverse portfolio of successful businesses contributing to strong financial fundamentals with lots of cash and low debt. This time-tested conglomerate offers stability and diversification across various US industries. Therefore, don't expect market-beating returns and be mindful of the uncertainties associated with any major change in leadership. I am currently invested in Berkshire Hathaway, but please do your own due diligence before investing in this business. I hope you enjoyed the video and see you next time.